Good morning, everyone, and thank you for choosing Market Briefing analysis of today's financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Financial news, June 6, 2023. Global stocks experienced a significant decline as traders anticipated further interest rate hikes in various economies, indicating their efforts to combat inflation. The European Stoxx 600 index recorded its largest drop in 2 weeks, while futures contracts on U.S. benchmarks suggested additional losses on Wall Street. The recent commentary from the Federal Reserve raised concerns among investors that policymakers would resume tightening policies. In the United Kingdom, the yields on 10-year government bonds reached levels not seen since the gilts crisis in October. Traders have fully priced in a peak Bank of England rate of 6.5% by March, the highest in 25 years. The fear of mortgage affordability issues also impacted the shares of home builders, including Persimmon plc and Vistry Group plc. Following a strong first half of the year, global stocks have started to lose ground due to ongoing hawkishness from central banks. The release of the Fed's minutes from their June meeting revealed a division among policymakers regarding the decision to pause rate hikes, with voting members likely to raise rates further this month. Eddie van der Walt, Tom McKenzie, and Anna Edwards discussed the key themes of the day on Bloomberg Markets Today. According to James Athey, the investment director at Aberdeen, the fact that the Fed has officially adopted staff forecasts for a recession in the U.S. is worrisome for risk assets. Despite expecting a recession, the Fed plans to raise rates at least twice more this year, which poses a challenge for assets priced at high earnings multiples. Investors are closely watching the upcoming U.S. employment reports to gain insights into the future policy path. The JOLTS report, which indicates job openings, is expected to show a tapering of available positions, while jobless claims are anticipated to increase. These reports will provide further indications of the labor market's strength and influence the Fed's decision-making process. Treasury yields rose across the curve following the release of the Fed minutes, with a 2-year rate reaching 4.97%, reflecting sensitivity to policy changes. Meanwhile, Treasury Secretary Janet Yellen is visiting Beijing to work on repairing the relationship between the world's two largest economies. In China, the central bank has extended support for the yuan by strengthening the daily reference rate. However, Chinese investors do not expect policymakers to introduce aggressive stimulus or major economic reforms at an upcoming key meeting, according to Goldman Sachs Group Incorporated. Looking ahead, market participants are interested in the earnings season and whether it will bring more profit warnings. This week, important events include the release of initial jobless claims, trade data, ISM services, and job openings in the U.S., as well as speeches by Dallas Fed President Lori Logan and ECB President Christine Lagarde. These events will shape market sentiment and provide further insights into the global economic outlook. Despite the Fed's decision to pause rate hikes last month, the minutes revealed that a significant majority of policymakers agree on the need for further tightening this year. This highlights the ongoing divisions within the committee as they manage the pace and intensity of policy moves in a restrictive rate environment. Federal Reserve officials reached an agreement to pause interest rate hikes during their June meeting but committed to raising rates again at the end of this month to continue combating inflation. The minutes from the June 13th to 14th meeting showed that while almost all officials believed it was appropriate or acceptable to keep rates unchanged within a target range of 5% to 5.25%, some officials would have supported a quarter-point increase. The emergence of diverging opinions was surprising given that the decision was portrayed as unanimous. The committee appears increasingly divided as it tries to manage the pace and intensity of policy moves now that rates are in a range that most economists consider restrictive. The Fed is not done yet. The minutes from the June meeting also showed that a broad majority of policymakers, almost all, agreed that further tightening would likely be necessary this year. This, along with a reference to the importance of post-meeting communication to clarify officials' intentions, provided ample evidence that the Fed is not finished with its work. Prior to the meeting, a significant minority of policymakers had warned that inflation was not decreasing as rapidly as expected, expressing support for additional rate hikes. Before we continue with our analysis, we'd like to remind you of your support for our channel Market Briefing analysis of today's financial news. If you're enjoying this video and find our content useful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and bring you even more quality content. Now, let's get back to the financial market news and the latest updates. The Fed's pause last month marked the latest policy move after officials raised rates at the fastest pace in 4 decades, including 4 consecutive 75 basis point increases. They began dialing back the speed in December and achieved quarter-point increases at each of the first 3 meetings this year. The rapid rise in interest rates since the start of 2022 allowed Fed officials to skip a rate increase and assess how monetary tightening and credit tightening following the bank failures in March were affecting the economy. President Jerome Powell has repeatedly emphasized that the decision was unanimous in several public appearances following the meeting and stated that most officials believe at least 2 more increases are needed, if not more. He has not ruled out consecutive increases. A strong majority of committee participants expect that it will be appropriate to increase the federal funds rate 2 or more times by the end of this year, Powell said at a conference in Madrid hosted by the Bank of Spain last week. Inflation pressures remain elevated, and the process of getting inflation back to 2% still has a ways to go. Powell's message helped narrow the gap between Fed officials' estimates, which foresee 2 more rate hikes this year, and market expectations. Investors now estimate an 85% chance of a rate hike in July, up from 62% before the Fed's minutes were released. Global stocks slumped as traders bet on further interest rate hikes by central banks, causing concerns about the global economy's soft landing. The European equity benchmark index suffered its largest drop in 2 weeks, while futures contracts on U.S. stocks indicated more losses on Wall Street. The UK also witnessed rising yields on 10-year government bonds, signaling worries about mortgage affordability and impacting homebuilders' shares. With central banks maintaining a hawkish stance, investors are anticipating the upcoming U.S. employment reports to gauge the future path of monetary policy. Treasury yields rose, and Treasury Secretary Janet Yellen's visit to Beijing aims to improve the relationship between the world's 2 largest economies. The market remains cautious as the Federal Reserve's minutes showed a division among policymakers regarding rate hikes, with some advocating for further increases. Some of the main moves in markets today. Stocks. The Stoxx Europe 600 fell 1.2% as of 10:53 a.m. London time. S&P 500 futures fell 0.4%. Nasdaq 100 futures fell 0.4%. Futures on the Dow Jones Industrial Average fell 0.4%. The MSCI Asia Pacific Index fell 1.4%. The MSCI Emerging Markets Index fell 1.3%. Currencies. The Bloomberg Dollar Spot Index was little changed. The euro was little changed at $1.0863. The Japanese yen rose 0.4% to 144.11 per dollar. The offshore yuan was little changed at 7.2564 per dollar. The British pound rose 0.2% to $1.2726. Cryptocurrencies. Bitcoin rose 2.2% to $31,128.17. Ether rose 1.7% to $1,942.86. Bonds. The yield on 10-year treasuries advanced 4 basis points to 3.98%. Germany's 10-year yield advanced 6 basis points to 2.54%. Britain's 10-year yield advanced 9 basis points to 4.59%. Commodities. Brent crude rose 0.5% to $77.02 a barrel. Spot gold rose 0.1% to $1,917.31 an ounce. In conclusion, we'd like to thank you for watching Market Briefing analysis of today's financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.